Hey, good afternoon. Okay, this is Meir Valensky with Driving Markets. All right, so what we're going to talk about today is we're going to talk about trading and investment. All right, there's a huge area. We'll never get everything covered in the next 5, 6, 7 minutes, or maybe 8 minutes, but we'll try to give you a little bit of background and try an explanation how things work. Okay, so we're going to break it down into a couple of topics, and today we're going to discuss trading in shares. All right, before we go into that, we have to give you a little bit of background as to the investment market. Investment market could be, for example, you can invest in property, you can invest in the stock market, you can invest in bonds, you can invest in cryptocurrencies, you can invest in wine and diamonds. So investments covers everything. And when it covers everything, you really want to become an expert in that particular area. So some people invest in watches, some invest in valuable pens. So what you want to do is when you come to invest or when you come to trade, you need to do your research properly, okay? Do your research and work out, is this an area I want to get into? Most people just get attracted from the peripherals or from the outside, the superficial attraction to investing in something. I know one guy, for example, invests in used trainers. So he goes onto Amazon or eBay and he buys used trainers that are limited edition, and he goes and sells those on the internet. Okay, so let's focus a little bit today on shares. All right, so what happens as follows is when a company wants to raise money in financial markets, in equity markets, it goes and sells its shares. It goes and floats on the stock market. Okay, so it goes into a bank. The bank's the advisor, so it could be Goldman Sachs, JP Morgan, NatWest, RBS, it could be Barclays, it could be Lloyds, it could be Bank Paribas Capital Markets, Deutsche Bank, etc. Goes to the advisor and say, we want to float our company on the stock market. All right, and when it floats its company on the stock market, it takes that bank that's advising it becomes the lead underwriter. So the lead underwriter is they take responsibility, ownership, and liability on making sure that that float is managed properly. And not only is the float managed properly, that the host company, the company that wants to float, ABC wants to float its shares on the stock market, is going to get full value for those shares. Okay? Excuse me. It's going to get full value for those shares. So that becomes a lead underwriter. So let's say the company wants to sell its shares for £100 million. Okay, $100 million, doesn't really matter. Okay, so what happens is the lead bank, let's call it JP Morgan, they take out the responsibility. They're going to raise the £100 million, $100 million for this particular company, and then they go to other banks which are co-underwriters and they sell that liability to the other banks. So the other banks say, you know what, we'll take some of those shares, and then they go and sell those shares all the way down to Joe Public. So let's now fast forward and let's say that that company now is floated on the London Stock Exchange. Okay, so it's floated on the London Stock Exchange. That company is now a public company. It's called a PLC, Public Liability Company. Okay, publicly limited company. Okay, so that company is now a public company floated on the stock exchange, and every year they will produce revenue, and out of that revenue there'll be, hopefully part of it will be profit. Now I just want to digress a little bit on this. Not all companies make profits, or not all companies make enough profits to distribute dividends. So that's an important point. Not every company that floats on the stock market makes a profit. So you do have companies like the high-tech stocks in the Nasdaq that have gone public, made huge amounts of capital growth, or the shares have shot up, but they don't actually make any money. So those are speculative companies where people speculate on them in order to see, is there going to be a big gain in their capital value of the shares that they're holding, but the company's not yet made any profits. All right, so to be aware of that and take that into consideration. So going back to now, the company's now launched, it's now public, it's floated, and it's quoted on the London Stock Exchange. Okay, let's forget about which index it is. It's just quoted on the London Stock Exchange. So that share now has a value, and that value is impacted and affected by economic conditions, trading conditions, inflation, interest rates, political conditions, communication, transport. Everything can impact the profitability of that particular company. all right? Now, as that company grows, hopefully it's going to make profits. I'm keeping it very, very simple now. If it makes profits, and it makes enough profits where it can distribute part of those profits, that is called a dividend, okay? So you're holding X number of shares, and they've decided to distribute 10% of their profits to the shareholders. So 10% of the profits, let's say £1 million, is now distributed amongst the shareholders. Depending on what you're holding, you will get a dividend. You'll get an extra payout over and above the value of what you're holding. And that payout is called a dividend. And that dividend is normally paid twice a year, okay, biannually. So if a company is paying out a dividend, it becomes attractive to those investors that want to receive income. That's considered income, dividend income, okay? It's taxable, but it's considered income. So it gives you further income on top of what you might be making in your salary, your job, your employment, whatever the case may be. You now have dividend income. So as the company grows and becomes more profitable, then hopefully that dividend income will increase. In addition to the dividend income, by the way, once the dividend's paid out, the shares now become ex-dividend, and normally they'll drop slightly, okay? But that's a separate issue. We can discuss that in a bit more detail in another session. So the shares become ex-dividend, and the shares are still growing. So the company's still growing, it's still making profits, and the next year you get another dividend twice a year, okay? You get another, so every 6 months you get a dividend, and that's a great investment for those people who want to receive income, additional income. Not only are you receiving dividend income, but as the value of those shares grow, also your capital value of your investment is growing. So as the capital value of your investment is growing, you've got capital growth and you've got dividend income. Now these days, in the last 20 years, a lot of focus has not been focused or not been concentrated on dividend income. What's it been focused on? Sorry, excuse me. It's been focused on capital growth. So those companies that are paying dividends effectively have been ignored, or they've been set aside. They haven't been sought after in order to attain additional income as far as your portfolio is concerned. But now, with obviously tech stocks that have peaked or looks like we're going to recession, there's a lot of focus now on dividend income. But I want to keep a general topic, not specific to this particular moment, all right? So those companies that pay good dividends could be, for example, petroleum companies, could be big retail outlet companies, okay? It could be energy companies could pay dividends. So you can look around and see what dividend they're paying. And sometimes the dividend could be 3%, 4%, could be 5%, could be 2.5%. It depends on the share value versus the actual profits of that particular company. But dividend income is a real great way to get involved in stock markets and generate income every 6 months. So every 6 months, like clockwork, if you're invested in a good quality company that is paying dividend income, then every 6 months that income will fall into your bank account and help you with all the costs, etc., etc. You could, of course, always reinvest the dividend and buy more shares with it if you want to, or you could just spend it. Okay, remember it is taxed by the Inland Revenue, so you will have a tax liability to pay at your higher rate if you've only been taxed at the lower rate. Okay, that's to do with shares and to do with dividend income. And over the long term, shares generally have an upward trend. Okay, shares generally move up over a 5, 10, 15-year period. Obviously, if you're a day trader, that's a different type of trading. We're only talking about long-term investment on shares, and you can keep on buying shares every year. In addition to that, there are portfolios they can build that could be tax-free. Okay, so you could have tax-free portfolios of shares like ISAs, individual savings accounts, or you could have it put it into 401k in the States, etc. And therefore you're putting them into a tax-free environment. So not only does the dividend become tax-free, but also the capital growth becomes tax-free. Anyhow, that's more or less it on a little bit of education regarding shares and dividends. Hope that's okay. I will do some more sessions as we go along, and we'll discuss other topics. We could be also day trading, could be crypto trading, could be bond trading, all types of trading, all types of investment in order to enhance your knowledge. You can share, subscribe. Speak to you soon.